Hello, everyone, and welcome to the TFDI podcast, which is brought to you by the Trade Finance Distribution Initiative. Here we discuss trade finance market trends and the evolution of the originate to distribute model. And today we're lucky to receive Bertrand de Cominges on the podcast to talk to us about what investors look for in trade finance assets. Bertrand is currently Global Head of Trade Finance Investments at Santander Asset Management. And before that, he spent over a decade working in the trade finance departments of HSBC, JP Morgan, and ABN AMRO RBS. So Bertrand, thank you very much for being here.
You're welcome. Thank you very much, Melody.
So let's start with your current role at Santander Asset Management. Can you tell us a little bit about it and how it differs from your previous roles in trade finance?
Yeah, absolutely. I joined Santander Asset Management, and I joined particularly the alternative asset class strategy within SAM, as we like to refer to Santander Asset Management. This is a team of newly creation. We are currently running 9 funds and 1.7 billion euros in assets under management. It is growing fast, it's growing quickly and successfully. Within that alternative asset class, I'm in charge, as you just referred to, the trade finance asset class. There are probably 3 aspects I would like to highlight of our work with the trade finance asset class. The first one is that we are not pretending to disintermediate anyone. We are here to intermediate between our investor pool, very sophisticated investor pool, and with the trade finance originating banks. There are just a handful of them that are clearly leading the market around the world and basically are in need of a solution as the one we are providing to them. The second element, besides intermediating between the players I mentioned first, the second element is that we provide, of course, we offer a well-remunerated medium-term investment to our investors, and to the originators, a stable source of liquidity into their balance sheets and into their business. That is much appreciated. The third element probably I would like to highlight is that contrary to others, basically in Santander Asset Management, we have true trade finance experts working hand in glove with true asset manager experts, both industry-leading experts in both elements. And that leverage, arbitrage, knowledge, common fertilization, we believe is critical to the success of converting trade finance as an investable asset class.
Mm-hmm. So we've been hearing more recently about trade finance distribution, and it seems to have grown and expanded as a practice. There was an article a few months ago about HSBC saying that it had increased the trade financing it sells on to investors and other lenders from $2 billion in 2015 to $28 billion in 2019. So that's quite a large increase. I wonder if you could give me your insights on why you think that non-bank investors are suddenly so interested in purchasing trade finance assets from banks, and what do they look for in those assets?
Well, I don't think it's a sudden interest from this type of investors. The secondary market of trade finance has been around for several decades, particularly very fluent in traditional trade products such as guarantees, where insurance companies are very proactive already with the surety market and many other alternatives, for example. Differently is on the open account space. This is basically receivables finance structures. Those are receivables finance and supply chain finance, as the industry common knows, the buyer-led receivables finance. There are 3 aspects that are very common to trade finance when run by a proper entity, such as the top leading asset originators. The first one is low risk. Throughout the time, once you know the market well, once you know your legal framework and the different aspects of the structures, this is a low risk solution, a low risk product compared to other similar assets. Second is the returns. trade is finance is generally, not always, but generally, most of the time, floor to zero. And in an environment of negative Euribor rates, this becomes very, very attractive, as you can imagine. And the third element is, of course, through open account, basically what we are participating, our investors are in core business by the leading banks in trade finance around the world. And basically, this well-structured business has very well diversified exposure to almost every industry, to multiple countries, to multiple aspects of the supply chain. And that makes it, that well-diversified portfolio, very, very interesting. Of course, if you add into that pudding the handling and the management, the fund management, the investment management of true experts in trade finance that are able to filter carefully the different structures, the different programs, etc., this makes this a very interesting asset class at the end of the day for non-bank investors.
Yeah, that makes a lot of sense. But what has kept investors maybe from getting into the trade finance world until recently? And are there still any obstacles to the development of this investment model?
Yeah, I think the major obstacle is education. When people talk about supply chain finance, for example, they put anything into it. I've seen even consumer finance being named as supply chain finance. So education, I think, is critical in this asset class because it's not yet common in the secondary market, in the capital markets, to have access to this type of products. Our investors need to understand that they are investing in real economy flows, real sales among corporates. And let me give you an example. A big electronics manufacturer is selling to a German car manufacturer specific components, $100 million, 100 million euros a month. And the auto maker is paying them on 90 days. Okay, this is basically what trade finance is doing. We are monetizing that supply chain at the end of the day. So we are investing on short-term basis. Our investors are investing in short-term basis, relatively similar to money market funds in some sense. There are big differences between these two. First is the asset origination. I already mentioned in your previous question. Money market funds originate assets majorly from governments and banks. Supply chain finance originate assets majorly through banks, not only, but through banks and in every single industry. Commodities, consumer products, fashion retail, food retailers, staple retailers, television manufacturers, car manufacturers, every single industry. And that makes it a very diversified pool of assets. So the first difference is the asset origination. The second is the returns. Returns today in trade finance are much more attractive, of course, than money market funds. You can see deposits being charged even up to 65 bips, whilst trade finance, because of the Euribor floor, is able to provide you interesting positive returns over your investments. So that returns element, that second aspect is very interesting as well. And the third element is the redemption process. Again, let me go back to my example in the auto sector. We are funding real economy assets. And sometimes these invoices that we are discussing on the back of our solutions have delay on payment, there are bank holidays, so the payment doesn't happen on a specific day, and they don't have a very fluent, very liquid secondary market. Therefore, the redemption process is different. I would say in a money market fund, you will have your operational cash, whilst in our fund, you will maintain a strategic cash. Therefore, we are focusing on investors looking for a medium to long-term position. Positive return, but medium to long-term position. And these are probably the aspects that are attracting this type of investors today into the trade finance world. But I don't think there are major other obstacles beyond education, to be honest.
Yeah, that's good to know. So I'm very interested in understanding more about the process of taking trade finance assets and making them investable for institutional investors. We hear a lot about we hear the word repackaging a lot. So I'd like to understand what that means, and having worked on both sides of the fence, both originating trade finance deals from the corporate world and now distributing those trade finance assets to investors, I think you're well placed to explain to me what needs to happen to sell those trade finance assets to investors.
Yeah. Well, in the past, I have to say, I was structuring and distributing as well, because for me, the distribution element, the secondary market element, is critical in the structuring. It is very important as well that the corporate that uses trade finance has a well-diversified pool of investors. Okay, so all the pieces of the puzzle get together. And therefore, education, I think, is very important. The top leading entities and the more secure to work with entities that are doing trade finance today, all of them have very flexible, agile distribution strategies. Okay, I think that's a very important element. But why do we think, and let me rephrase, how do we make trade finance an investable asset class? First of all, because of our experience, we take a very prudent approach to the elements and the assets we are sourcing. Secondly, and at the same time, we are proactive and we apply discretion in our investment management approach, and that's very important. We work with the best because we know they have the right environment to provide the right risk management to our investors. Secondly, we invest in core business of our partner asset originators. And we invest in transparent real economy asset class. We don't use fancy words. We name things by what they are. And we are participating in that core business. So we are taking pro rata participations on transactions that have been around for a long period and that for our partner asset originators are core to their business. We are not simply a bucket in which assets are being put into. Actually, we are building a fund that is here to stay, that will be a critical element of liquidity as well, not only for our investors to position these short-term, medium-term cash positions, but also to our partner asset originators. So the first one was prudent, proactive, and discretionary investment management approach. The second is core business, in which we are investing with our partner asset originators. And the third element is that our participations are uncommitted. Therefore, if there is a deterioration of any entity, of any element in our portfolio, we can quickly, on a real-time basis, stop funding these assets and therefore sourcing these assets into our fund, making this very agile, as you can imagine. So these are three very important elements. I think your second question was regarding the repackaging of this repackaging structure on how we are operating. Well, we do work with our operating fintech partner, a market-leading fintech partner in this element. Our RIFE cap as well as the SPV we engage are both located in Luxembourg. So this is a very standard structure at the end of the day. And thanks to our fintech partner, we have real-time visibility to our portfolios. That allows us a real-time sourcing of data that our credit and risk teams can monitor on a daily basis, and therefore our fund managers, our investment managers are making good decisions, well-informed decisions in order to protect the investment of our investors, as well as the liquidity source to our partner asset originator.
Okay, I understand. I think you've answered this question already a little bit, but I will ask it anyway. Why is Santander Asset Management so well positioned to make this transition happen and make the practice of trade finance distribution more widespread?
Yeah, well, There are several aspects to it, and probably you're right. I'm very passionate about my job, so probably I already answered this. But let me answer this in a different way. Okay, why Santander Asset Management is so well positioned? Well, I would say number one is the Santander Group. Okay, in the world of trade finance, Santander has been a leading in the trade finance, leading bank, leading institution in trade finance for many, many years. Allegedly, they invented supply chain finance in a fully automated basis. It's called confirming, and it's a copyright word, actually, that belongs to Santander, and is with several thousands of facilities around the world, is probably the world leader by a big margin in supply chain finance, but also has a very competitive, extraordinary receivables finance solution. And remember, in our fund, we are focusing on open account. So we are focusing on these trade solutions, receivables finance and supply chain finance. But on top of everything, culturally, a bank, there is a corporate bank, there is a relationship bank, there is a commercial and retail bank, is ingrained to support trade finance, because trade finance is the blood of the economy, is the blood of commerce, is the blood of trade. And therefore, its credit risk compliance teams are very much ingrained and to understand this business. The business of trade finance. And therefore, that makes lots of sense altogether. You take Santander Asset Management, an industry-leading asset manager, with Santander Group, a global leader in corporate banking and in trade finance, and you leverage that culture in a transparent basis, and actually makes sense and positions the institution in the right place, in a good and honest position to basically lead this market.
Yeah, that makes a lot of sense. We're reaching the end of the podcast, so thank you very much for all your insights so far. But before we go, I'd like to end on a more personal note and ask you, what's the most inspiring thing that you have read lately? Be it a book, a comic, anything, and it doesn't have to be related to trade finance.
Well, it will be a letter of one of my daughters, but that will be too personal probably for the listeners of the podcast. So just recently, I'm reading a series of essays from Seneca, or Seneca the Young. Seneca was a philosopher of the Roman times. He was born in the city of Cordoba, in what today is southern Spain. He wrote a series of essays in multiple aspects. He was an Stoic philosopher, such as Marcus Aurelius, the Roman emperor. And I've been reading these essays about happiness, pleasure, virtue, serenity, and many others. But one of them, and these are very short books, so anyone can buy them, and they are perfect as a breakout moment of, especially in these times of lockdown and working from home, Zoom meetings, etc. And the one I find particularly interesting and quite humorous, actually, it is the shortness of time. And Seneca's argument is that it is not that we have a short space of time in our lives. It's actually that we waste much of it. And he argues that life is far long enough to achieve whatever we want to achieve, is sufficiently generous with us, but we get over busy doing multiple things that actually are consuming that time, that valuable time of our lives. So I hope the listeners will enjoy the reading of The Shortness of Time by Seneca.
Yeah, that definitely resonates, I think, especially with what happened last year and all the lockdowns. And I think we've rediscovered what time is, and we've changed the way we see it. And I hope that there's been some positive changes in our approach to time and how we use it. But yeah, that sounds very interesting. I'll look it up. Thanks very much for that. So Once again, thank you
Thank you,
so
Melody.
much, Bertrand, for taking the time to share your insights. And I also want to take this time to thank everyone who is listening to the podcast, and make sure to leave us your thoughts on this episode in the comments. Thanks.